Oh, hey, it's spring here in the Coachella Valley. Look at this right here. It is gorgeous out there. We've got a little snow cap, and then it's absolutely gorgeous down here in the desert. And if you want to get outside and do some things, today is the day. It's about 80 degrees outside today, and it's just begging you to get out and play some golf or hey, how about some pickleball? Hey, before we get started, let's bring in the man of the hour, and that is Art Alvarez. You are at MortgageWorks. Hey, Art, how you doing?
Hi, Jeff. How are you?
Hey, I was just reading this morning about baseball and how this whole clock thing is going on, and it's making the games faster. And I know you're a long-time baseball fan, not just any baseball fan, but you're a fan of what team?
Well, in recent years, I'm sorry to say, I've been a fan of the Angels for ever since I was a kid. I grew up near the stadium. First time I went to an Angel game, I think, was 1966. So,
wow,
been a fan for a long time.
Well, you've seen it go through. It's almost like being a fan of the Jets. You have to have more invested in just the love of the Jets, but the love of the game. I mean, you've probably seen it change a little bit over the years, huh?
Oh, for sure. Of course, again, back when I was growing up, you go to a game and, back then, unique idea. The pitcher actually pitched 9 innings. Now it's like consider they're doing great if they can get through 5 or 6. So it's interesting, and then after that, you end up seeing 4 or 5 pitches before the game's over. That's not how it was back in the day. So for sure.
Have we just become more fragile as we become paid more?
Well, that's what the old timers think. Yeah, for sure.
I think so
Talk
too.
to Nolan Ryan. He's got some attitude about that.
Geez, I tell you. Well, I know we could talk baseball for a long time, but that's not the meaning of the show. It's called Mortgage Minute, and it's about all things about keeping you up to date about what's happening in the marketplace. I know Art's got a lot of information. I'm going to step away, but I'll be in the background. So when you have questions, please put them in the comments. I'll bring them to Art. He'll answer them live because this is what, Art? This is where if you have questions, we has answers, and they're on the house. With that, I'm going to turn it over to you, Art.
All right. Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. I've got a lot of information to cover, so I want to jump right into it. As you know, we always start with giving you an update on mortgage rates and the bond market. There's our rate grid right there. I'm optimistic about the fact that we're kind of holding in these levels in the 6s for the most part. As you can see on the screen, conforming loans are still right around the mid 6s. The FHA VA loans right around high 5s to 6%. So again, the glass is half full. Part of that is rates remain relatively stable, even in what is otherwise maybe a little bit of a volatile market. The 10-year bond yield chart tells an interesting story for this past week. As Jeff just pulled it up, you can see last Friday when the bond yield actually was dipping below 420, and then of course as we go into the beginning of the week. It jumped up, quite a bit. In fact, at one point earlier this week, the 10-year bond yield actually got over 440 and was approaching 445, which of course could be potential panic time for prospective home buyers and so forth. But it's settled down a little bit. And what's interesting is part of the reason for this, big increase in the yield during this week has to do with the fact that we've had a lot of economic data this week. Totally unlike last week when the U.S. economic calendar was very quiet in terms of data points. So what's going on? Well, let's start with last Friday. When you looked at that chart, you saw that yield was right around 420, a little bit less. Well, last Friday, Fed Chairman Powell gave a talk, and of course it was on Good Friday, so the markets were closed. But that was also the day that the PCE, the Personal Consumption Expenditure Index, was released. And remember, that's the Fed's favorite inflation measure. And it came out and it was not hot. It was actually somewhat subdued. And after that was released, Powell's comments were basically reassuring the market that the Fed has not changed their stance. They're still expecting rate cuts to occur sometime later this year. So that was good news going into the end of the holiday week. Markets were closed, so the expectation was on Monday, with that positive comments from Powell on Friday, that we would open the week relatively stable. Well, that didn't turn out to be the case. On Monday, we had a pretty big jump in the 10-year bond yield. Why? the ISM Manufacturing Index, that's the Institute of Supply Management, released the manufacturing index for the previous month, and it was over 50. In fact, it was about 51. The previous month, it was 47. That's the first time in 17 months it's been over 50, and over 50 is considered a strong manufacturing environment. So, of course, what did that do? The markets react. Again, reptilian-like minds, they react quickly. Aha, the markets, the economy is strengthening, bad for bonds, yields went up. And then the same thing happened the following day on Tuesday when factory orders also came in quite a bit stronger than the previous period, the previous month, 1.4 in March. It was minus 3.8 in February. So again, that was underscoring the fact that the economy seems to be getting very strong, and that's what got Treasury yields elevated. And the JOLT report, remember, job opening labor turnover, that actually was no change from the previous month, 8.8 million openings, same as the previous month, but yet the markets read that as evidence that the job market continues to be robust. It's kind of an interesting interpretation, but nonetheless, that was the way the market interpreted that particular data point. And then we had ADP. Now, I've said before, I don't like ADP's numbers. I think they can be far off at times, but they came out this week declaring 184,000 new private sector jobs, a big jump from the previous month of 155. So, of course, that was created a negative bias on bond yields as well. And then to add even more to that, on Wednesday, we had interesting comments from a couple of Fed participants. The Fed president out of Atlanta, Bostic is his name. He was on record on a television interview saying he isn't thinking there should be no rate cuts until the fourth quarter, which of course deviates from the market expectation that we should see a rate cut in June. And yet, contra to Bostic's comments, Powell's out again the same day with more comments in a speech where he says their overall outlook hasn't changed and they do expect rate cuts at some point this year. So a little bit of a cross signal there between the Fed president, the Fed chairman and one of the Fed presidents. So, and in fact, and today what we did have, although it's not on the slide, initial claims for unemployment. Big jump, 221,000 over 212,000 the previous week. And that seems to conflict with the ADP numbers saying that was a bunch of new job openings. Interesting that could be the case when we also have this week a big increase in unemployment claims. So a little bit of a cross signal there. So what I would tell you in terms of rates for the rest of the week and going into Monday, tomorrow would be the next big day. Watch the non-farm payrolls. That's the government data point for new job creation. I think that tends to be more reliable and a better data point to focus on. That comes out tomorrow, as well as the unemployment rate. One thing I'll tell you again, I've mentioned it before. If we see an unemployment rate hit 4% or more, I think that could be a market mover in the bond market to the positive. In other words, that could be a sign of maybe some weakening in the labor market. I think that's a big focus on that the Fed has. So if we end up breaking that 4% threshold on the unemployment rate, I think that could help us with some improving rates, from going forward from there. And remember, I also said the 4 and 4 rule. Look for 4% unemployment rate. Look for wage growth to drop below 4. If those both happen, then that's a pretty good sign that maybe finally the labor market is weakening and we could see improvement in yield. So keep an eye on that. We'll see how that plays out over the following, this next week coming up. So with that, I want to go into an article that I saw just earlier this week that, again, caught my attention. I'm always looking at information and news stories regarding the financial markets, mortgage and bond markets in particular. And so I saw one here that really kind of goes against the flow of what the common narrative is about how home buyers struggle with coming up with down payment funds. And so I see this article. It's actually out of a publication called Mortgage Professional America. We get that every day. It's a daily newsletter about the mortgage industry. And despite high rates, despite high home prices, home buyer down payments are skyrocketing, meaning the amount of down payment is going up significantly. In fact, this article pointed out that in February, the median down payment amount was $55,640. That means on average, and again, these are national numbers, buyers now are putting on average about 15% down. A year ago, it was 10% down. And that 55,640 median number in February, that's up 24% from a year ago. So that's amazing if you think about it. How is it that so many home buyers are struggling to come up with down payment funds, and yet down payment amounts are going up, and they're going up significantly in a pretty short period of time? So what's driving that? Well, one thing is, of course, rising home prices. Just do the math. If home prices this year are 8% more than last year, when just by function of the increase in price, that kind of forces the buyer to have to cough up more down payment in dollars because of the higher price that down payment is working off of. So that's an obvious reason, or part of the reason, for these down payment amounts going up. The other thing is, the article suggests, is ongoing impact of high mortgage rates. The idea there being that home buyers are battling or fighting against high rates by putting more money down. In other words, they're trying to use higher down payments to help reduce that monthly payment because of today's quote unquote high mortgage rates. Well, that's kind of interesting. I'm going to touch on that here in just a second, is why I think maybe, while that may be happening, that's not maybe the most effective behavior to pursue in order to combat these high mortgage rates. The other thing that was interesting to point out is that cash purchases are a big portion of the total activity in the existing home marketplace. We're talking almost, in fact, over a third of purchases in February. Again, national numbers, 34.5% were cash purchases. Now that's really challenging. Of course, in the mortgage business here, we talk about, in the fact, there was a mortgage originator here in the Valley who used to say, just say no to cash. Well, guess what, folks? There's a lot of cash out there, both here in my local market as well as throughout California and nationally. A full third of buyers are paying cash. So there's a lot of cash out here. The problem with that is it's not good for first-time home buyers. They're at a disadvantage in this market. It's hard for a first-time home buyer that's only putting 3 or 5% down, and maybe their credit score is okay, but not stupendous. They're having a hard time competing with other buyers who are offering cash for properties. And in a lot of cases, those cash offers are from investors. In fact, at the end of 2023, more than 1/4 of lower priced homes were bought by cash investors. What the idea is, are buying those either to flip them or more likely maybe just to rent them out. And so that makes it very difficult for a first-time home buyer. The other interesting bit of data that came out of all this is that over a third, 36% of the younger buyers, the Gen Z and millennial buyers, are using cash gifts from family to try to get their first home purchase done. And again, that does help with that down payment amount, to the extent that they've got family members who are generous enough to give them more than just the minimum down in their effort to try to get those monthly payments down. But that begs the question, overall, the premise of this article: is more down payment the best way to lower your monthly payment? Well, if you've watched my program at all or heard me speak at all about this, you know my answer. And the way I can answer that is, remember, each $1,000 additional down payment is only going to lower your monthly payment by about $6 a month. So think about it. You put $10,000 more down, you're going to lower your monthly payment by $60. Well, that's helpful, sure. But when you consider the amount of cash additional out of your pocket and the amount of monthly savings, I think there's an imbalance there. I'm not sure you're getting quite the bang for your buck. In fact, most time when I have somebody ask me, what if I put more down? Will that help me with my monthly payment? And when I show them the numbers, usually they're disappointed that the improvement in payment is not as great as they thought it would be with that extra $5,000 or $10,000 or $15,000 down. So the moral of that story, and my comeback to this article, yes, home buyer down payments have gone up quite a bit. But if that's happening at all because of an effort to get your payments down, there's a better way. You know what I'm going to say. I've talked about it a lot. I'm going to continue to talk about it. In a lot of cases, don't worry about trying to get to that 15 or 20 or 25% down. You can put less down, and then negotiate a temporary buy down. If that's what you want to do to get monthly payments lower, negotiating a temporary buy down is a much more effective way to get a lower monthly payment. So I can't reiterate that enough. And in fact, given that I'm suggesting that, I want to go to the next slide, because I've got right now a real life example that I want to share with you. And you can see on the header on this slide, I've come up with a sort of a new phrase: buy downs are the bomb. I truly believe that buy downs are a great way to address today's both high home prices, but in particular high interest rates. I'm going to say high, in quotes, because from where I come from, 6 to 7% is really not high historically. So here's an example. This is a transaction that we're involved in right now. We're getting ready to close it, actually, but here's how it came together. And this was done right here in my local market in the Coachella Valley. SFR listed for $499,000. The buyer's agent came to me, had me pre-qualify the buyer. There was some talk about what they plan to do with the offer. And ultimately that discussion led to, in part by me bringing it up, buyer decides to offer under list price. I had suggested just go in at list and ask for a seller credit to be used for temporary buy down. Well, what they did is they submitted an offer at $10,000 below list at $489,000. They did request the $10,000 credit to be used for a 2-1 buy down, with the buyer paying a 15% down payment. Well, after submitting that offer, the seller countered and came back and asked for full price. So the seller responded with a counter offer saying back to full price, $499,000, but they did agree to the seller credit. That's an important point. So ultimately, and then, the agent and the buyer, talked to me about it. And I said, look, I think that's a good outcome. Even at full list price, getting that credit is very important because it's going to substantially improve the buyer's loan terms. So here's the actual numbers involved in this transaction so you can see what I'm talking about. At the full list price of $499,000, with the seller agreeing to that $10,000 credit, the note rate on this 2-1 buy down is 6 7/8. The principal and interest for that, based on the 15% down, $27.86. So that's going to be the note rate on the loan once the buy down period is over. But with the buy down, the first year rate is 2% lower, 4 7/8. So the principal and interest is only $22.42. That's like $550 a month lower than the note rate. The second year at 5 7/8, the principal and interest is $25.09. Again, about $250 lower than the note rate. That's a substantial monthly payment savings over the first 24 months of the loan. And compare it to what could have been. What happens what would the payment be? What would the principal and interest be if instead the seller agreed to the $489,000, the low price offer, $10,000 under list price, but said no to the seller credit? Well, some buyers would say, oh, I'll still take that. I'm getting it $10,000 under list price. That's a good deal, right? Well, yeah, but understand this. If this buyer had gotten $489,000 accepted, but without the seller credit, no buy down would be available. And that 15% down would mean based on the based on the loan amount, the principal and interest at $489,000 with no seller credit, no buy down would be $27.30. That's still about $500 a month more than is going to be the case on their first year rate with that 2-1 buy down at 4 7/8. Needless to say, the buyer ended up being very, very pleased with the outcome here. They were okay with paying full list price. They got that $10,000 credit. So the seller did concede. They conceded $10,000. Their net price essentially is $489,000, and they're giving that buyer $10,000, using that to subsidize their interest rate and their payment for that critical first couple of years. So this is a real world example, something that we're actually getting ready to close this deal soon. This is a real world example of a temporary buy down at full list price that features a superior payment term over a lower price offer. So I can't stress that enough. I wanted to share with you this real life example. As we originate and have loans in process involving buy downs, you're probably going to hear me talk about it again and show you further examples, because I think if this is used more often, I think that's going to help both buyers and sellers get more homes sold. So I'm happy to share that with you. If you have any questions on this or have any ideas about a particular property and what the numbers would look like for a buy down scenario, please get in touch with me. I'd be very happy to give you some numbers and give you some ideas as to how to use a temporary buy down in your real estate purchase negotiations. So with that, I'll go ahead and go to the next slide. And with this, I'm just going to share a couple of tidbits, I will call it, about the mortgage industry. In part of this is going to be sort of touting what we do as a mortgage broker, as well as give you sort of an update on trigger leads. First of all, mortgage broker share. Interesting to know. News just came out. The mortgage broker channel market share reached a 15-year high of 24.3% in quarter 2023. That's the source of that is the nation's largest wholesale lender, United Wholesale Mortgage. So again, the mortgage broker channel, what that essentially means is that's the mortgage wholesale channel, meaning that that channel serves mortgage brokers like us, what we do is originate and process the loan, submit it to the lender for underwriting and funding. So our type of origination company, mortgage brokers, now represent about a fourth of the total mortgage market in the industry. That's the highest since 2009, 15 years. So what is that? And by the way, what this also underscores is based on the 2021 HMDA data. Now, HMDA is the Home Mortgage Disclosure Act. That data, which is compiled of data from lenders throughout the country who have to submit their data to HMDA every year, that data shows that consumers save on average $9,400 over the life of the loan when they use a broker compared to a bank or retail lender. So that kind of explodes the myth that mortgage brokers are going to charge more and it's going to cost you more because they're a middleman and they got their fees that you got to pay in addition to the lender fees. That's pretty much a myth these days. Mortgage brokers are the low-cost provider of mortgage loans, and they have access to very competitive pricing with wholesale lenders. So you'd be surprised how often a mortgage broker can oftentimes prevail when you're price shopping, and you're going to find a mortgage broker like us are going to be able to provide you a better deal, even compared to the big banks, even compared to the big retail lenders like the Rocket Mortgages of the world and so forth. And it shows a growing consumer confidence and a demand for independent brokers, in part because we price our loans more aggressively. We can provide lower cost loans for the borrowers, and as a consequence, and we give buyers more choices. We have more product offerings. So if we have a buyer come to us applying for a mortgage for a purchase and we can't fit them into one particular program, we will have others we can share with them and help them with. A lot of the major banks and so forth have a narrower menu of loan products, and so they can't provide as many options for that borrower. So keep that in mind. Mortgage brokers are a big force in the industry, and I think they're here to stay. The other thing I want to talk about, I've talked about it before, trigger leads. Remember, trigger leads are when you apply for a mortgage and when you have a hard pull credit report pulled by your mortgage originator, the credit bureaus, believe it or not, sell your info to mortgage originators. And then what happens is that consumer who's just applied for a mortgage gets bombarded with phone calls and emails and text messages. They're overwhelmed with an influx of calls and offers to try to lure them away from their chosen lender. I just want to remind you, there is legislation underway. It's called the Home Buyers Privacy Protection Act of 2024. So that's moving through Congress. The idea here is if that passes, there's going to be a significant restriction of trigger lead activity. The ability to buy those and what you can buy in terms of leads that you can pursue with borrowers, that's going to be greatly restricted from where it is now. And I want to remind you that in the meantime, if you're contemplating that you're going to be in the market for a mortgage in any time in the near future, whether it's a purchase or a refi, you have the ability to opt out from these trigger leads. You can opt out from credit and insurance offers by going, as it shows on the screen, go to optoutprescreen.com. You can go on that website, or you can call that number 1-888-5-OPT-OUT. Either way, online or with that phone call, you can get on the opt-out list. And that way, when you do step forward and decide to apply for that mortgage, again, whether it's a purchase or a refi, if you've done this first, then you won't get harassed by these trigger leads after you've applied for that mortgage and had your credit report pulled. So I just wanted to give you that reminder. I just, again, recently had another customer who hadn't done the opt-out, And after we started their transaction, of course, they got that, overwhelming crush of calls and text messages and emails trying to lure them away. So it can really be disruptive and I think abusive. And so you can avoid it if you follow these options to opt out from those calls in the future. And again, you can learn more about pre-screened offers at consumer.ftc.gov. So just wanted to share that with you and remind you that trigger leads are still out there. Hopefully they're going to go away soon. But in the meantime, here's your way to avoid them in the future and not be harassed. Okay, for the next screen, what I want to talk about, we're going to go into the closing question from last week. And it was a good one, and I think it's very appropriate. And I've got some thoughts about it as well that you'll hear in just a second. Here's the question. When buying a home, how are the escrow and title companies chosen? And can a buyer shop around for those services to get a better deal on their fees? And of course, my response is great question. And my short answer is yes, but it's yes, but. And again, this is a timely question. I closed a purchase loan here in my market in Palm Springs about a month ago. And when we first started the transaction, the buyer contacted me and she asked me about, can she shop around for the escrow and title services? And I thought it was interesting to get that call because that's a rare call to get from a borrower. It just almost never happens. So let me kind of explain to you why that is and what has been the sort of the custom on this particular topic. It has become sort of a custom. It's not required, but it's kind of become a custom in the existing home market that the seller is likely going to be the party to choose the escrow and title providers. And by the way, escrow and title providers also are known as settlement agents. So that's an umbrella term that covers, escrow companies, independent escrow companies, title companies, settlement agents, by the way, in some parts of the country can even include attorneys and so forth. So yes, it is customary or has been that a seller will choose those services, but it doesn't have to be that way. It can be negotiated when submitting your offer right there on the purchase agreement. Here in California, we call it RPA, residential purchase agreement, right there in the form. There's a space where you can basically negotiate that. You can mark seller to choose, buyer to choose. And sometimes some buyers' agents, when they submit their offer, will attempt to declare who they want as the escrow and or title company to handle their transaction. Now, that's not always approved by the seller, but some agents will make that request. But I would say in the majority of cases, on the buyer side, when they're submitting their offers, they end up just kind of rolling over and saying seller to choose. And what's interesting about this customary practice is, in my opinion, it allows settlement agents to avoid fee scrutiny. Unlike us on the front line of interaction with the customer when we're starting the loan application, obviously we're under fee and rate scrutiny right from the get-go. They, obviously borrowers want to know what's the rate going to be and what are my closing costs going to be. And settlement agents, I believe, tend to be more or less kind of shielded from that process. They're not having to kind of present their fees directly to the consumer and defend them. So what ends up happening is settlement agent fees are usually just accepted in the transaction by the buyer without question. They just don't even question it. But here's the part that kind of gets me going a little bit. Despite the fact that the settlement agents really don't get confronted about their fees directly from the consumer often, that doesn't mean those fees aren't subject to some sort of scrutiny. But the way it works kind of puts us in the middle. We, as the mortgage originator, we're the messenger now, and we have been for a long period of time. We are required to disclose all the fees in a mortgage transaction to the buyer, including the settlement agent fees, the escrow and title fees. We have to disclose that to the buyer, even though we're not the one who's charging those fees. So we end up being the messenger. The settlement agent doesn't directly communicate that to the customer when the loan is starting or the escrow is starting. And there are tolerance limits on those disclosures that we have to prepare on all the fees, including escrow and title fees. In fact, for the escrow and title fees, the tolerance limit is 10%, meaning if we undisclose settlement agent fees by more than 10%, that creates a problem. that's a tolerance failure. And then there ends up having to be some corrections made to account for that. And that can sometimes, kind of create some bumps along the way in the process. And so, to me, in my opinion, that is something that really, I think, I'd like to see it change, but unfortunately, it's sort of the current environment. What I would want you to know is, yes, you can negotiate those. Yes, you can even shop around, but understand that depending on the fees involved, some of them are going to have relatively small variance. Title companies, like for title policy insurance, that's regulated. It's an insurance product. They're regulated. So most title companies, in terms of their owner's title policy and lender title policy fees, are going to be relatively in close range. The variance is not huge among title companies. So, more in the independent escrow companies, on the other hand, sometimes you can see their fees have a wider variance from high to low. So to the extent you want to spend your time shopping for fees, well, number one, you should probably talk to your agent. If you're a buyer, talk to your agent and ask them what they think about that, and get their advice if they think it's worth your while. And then understand that if you do shop around, you may end up finding that the variance isn't so significant that it's worth your time to continue to do that. And I think that's part of the reason why this custom has just settled into where sellers end up choosing it most of the time, and those fees really aren't questioned by the people paying them, the seller and the buyer. And in that respect, I think the settlement agent's got a pretty good deal in terms of just being able to avoid that whole process. Because, there's some folks out there really are shoppers on fees and rates. We have to deal with that daily. I think they're kind of lucky, and I'm kind of jealous that the settlement agents don't have to quite go through that scrutiny as much as we do. So it could be worth your time. Talk to your agent. If you have an agent representing you on a purchase deal, get their input as to whether or not you should shop around, what the benefits and the cons are of doing that, and whether or not it's really going to be worth your time. But a great question. Hopefully that gives you a little bit more clarity as to how that whole part of the process works. And with that, I'm going to go ahead and jump into our last slide, which is going to be our closing question for next week. This is a good one. It's an interesting one. ARM loans, adjustable rate loans. Or adjustable rate mortgages, which, of course, in this environment, and this has been the case for many years now, ARM loans as a percentage of total volume have not been very significant, and that continues to be the case. But let me go ahead and read you the question. I remember when adjustable rate loans were called LIBOR ARMs, but now they're called SOFR ARMs. Why the change, and what's the difference? Well, stay tuned to next week's Mortgage Minute, where I'll have the answer to this question, and it will be on the house. Thanks. Jeff, back to you.
Art, another great show. A lot of good information there. I love the whole idea about, and I get your point about having to disclose someone else's fees and having to defend those if it does come up. That is a luxury that that the settlement agents enjoy, and I'm not sure they ever kind of pull you aside and say, "Hey, thanks for handling that for me."
No, they don't actually. And the one customer I had, last month, or it's been, I guess, more closely to 2 months ago, because we closed it about a month ago. I did ask her. I said, "How did it go?" Because in this case, what they did was, we'd already gotten the offer had already been accepted, and escrow had been opened. But the buyer, my borrower, wanted to know, "Hey, is it okay for me to question the fees that the escrow company and the title company are charging?" I said, "Sure, feel free." I recall her telling me that she made an effort to do that, and she got a little bit of a resistance. I think she started with the escrow office, because in this case, it was a transaction where there was an independent escrow company and then a title company, which is common more in Southern California. And she got a little bit of pushback, because, again, these escrow offices and the title company offices, they're not used to those kinds of questions. And they're, I think, a little bit ill prepared as to the best way to respond to that, and explaining to their customer, because the borrower is their customer too, and explaining to them what they're charging and why. I think they're a little bit rusty on how to do that. We do that every day, so we're pretty good at it. Plus, it always helps if you charge less fees than most of your competition anyway.
That's true. Speaking of that, you are the home of the 1% broker fee. Tell us about that.
Well, yeah, I mean, that's something that we've been doing for a while. It occurred to me that in this industry, with rates higher, with home prices higher, everything's higher. People are looking for ways to save money. And when it comes to originating a mortgage, I've come to the realization after all my years of doing this that I think there needs to be a little bit of a change as to how people like us, charge for our services. I think that in too many cases, mortgage originators are charging too much for the services they're performing. With most loan amounts that we have, I mean, they're decent sizes, $3, $4, or $5,000 or $500,000 or more. If we end up getting a 1% compensation from the lender, because that's how we're paid. We're paid by the lender, not by the borrower, except in rare circumstance. So in my mind, when we set up our lender paid comp with our lenders, I came to the conclusion that we need to put the best numbers before a borrower as possible in terms of cost or rate. And so we decided to change our lender paid comp declaration with our lenders and reduce it from what we used to have at 1.25% down to 1%. The reason for that is to ensure that we're going to provide the most optimum rate possible to that borrower, so that if they do decide to rate shop us, they're probably going to be pleasantly surprised that after doing that, they're going to come back to us and realize we really are giving them a pretty darn good deal compared to other mortgage originators that are out there. So
when it comes to that, Art, just real quickly, is, what do you see as the average when we talk about your competitors out there and you're offering 1%? How does that typically stack up? Is there a way for you to see, hey, this is the average that's being paid out there is for broker fees?
Well, the way I've kind of dived into that and identified where we stand versus other brokers is I talk to the wholesale lenders that we deliver loans to. With each lender, we have an account executive assigned to our account. And I've interviewed or talked to many of them and asked them, so, tell me, how does MortgageWorks stack up against your other broker customers in terms of lender paid comp? Are we on the low end or are we on the high end? Without question. And this has not been true even when we went to 1%, even at 1.25%. Almost without question, every single account executive I asked that question to has always said, you guys are on the low side. And a couple of them said, you should charge more. Why are you originating loans at 1.25% or now 1%? And I was like, really? So what are your other brokers? What's their lender paid comp declarations? And I've heard pretty much every response I've gotten has been somewhere between 1.75% to 2.25% of the loan amount.
Wow.
Now, with that kind of difference, if I'm competing with a broker who wants a lender to give them 2.25% of the loan amount for delivering the loan to them, I'm asking for 1%. If I'm doing that with the same lender, guess what? That borrower, if they go to broker A for that 2.25% lender paid comp that they want, versus come to us for that 1% lender comp that we want, and if the loan's going to be funded by that same lender, either way, they're probably going to see a interest rate at least a quarter, maybe even 3/8 higher with that other broker than what we can offer. So that's how it basically, follows through to the end borrower as to our 1% lender paid comp declarations with our lenders. It's going to give them a better rate.
So it can be very significant then.
Yes.
Wow.
Yes.
Well, make sure to reach out to Art. His information is on the screen at MortgageWorks. Art Alvarez at 760-883-5700 or $5,700, not dollars, 5,700 or 714-612-9035. That's his cell number. It's always on and it's ready to take your call. The website is mwloan.com. You saw it at the very beginning. There are a lot of great tools on there, as well as articles to help solve questions that you might have if you want to start out there. And then, of course, you can always email Art at mwloan.com. And as we say, hey, the 1% lender paid broker fee equals saving you money. Art, great job, great story, and look forward to seeing you next week. Have a great weekend. Oh, and hey, go Angels.
Well, I don't know about we've won 4 straight. We started 0-2. We've won 4 straight. We're 4-2 now, but the Red Sox are coming.
Oh,
and the Red Sox, I'm sorry to admit, they've had our number for years. So fingers are crossed. It's opening weekend, Angel Stadium against the Red Sox. Go Angels is right, because they're going to need it.
Are you going to be there?
No, I've opening weekends they're too expensive. I mean, I'll watch it on TV. It's a better seat, and I've got better beverages and food options. So
100%. Well, have a great weekend, and
right.
I hope the Angels play well and can surprise the other team.
Yeah, they might. All right. Thanks, Jeff. Thanks, everyone. Thanks for watching this week's Mortgage Minute. Stay tuned next week for our Mortgage Minute program a week from today. In the meantime, have a great weekend, and we'll talk to you soon. Thank you. So long. Take care.